Tesla is down 27% year to date, down 4% just yesterday, and heading towards its 52-week lows. So is this an unbelievably undervalued price to buy Tesla for some extreme gains over the next few months and years? We're going to find out in today's episode. We're going to do a deep dive. We're going to look at the income statement, looking at their top line revenue growth, as well as their bottom line net income over the last few years. We'll also look at the health of this company, their balance sheet, total cash versus their total debt. And we want to see how well they're performing or how poorly versus the other companies in the Mag 7 over the last year as well as the last 5 years. And as always, we want to analyze the institutional ownership, whether institutions themselves are buying at this price that some consider to be extremely undervalued. And we'll run through some insider selling that we have noted over the last few weeks, discuss our thoughts. And don't forget, we always look at the financial metrics. It's important in understanding the business. Are they moving in the right way? And realistically, we want to understand, why is this stock continually to tumble day on day, week on week? And as we can see, the last few months have been very, very horrible for this company. Don't forget, as always, we will run them through the valuation model. We want to get to our intrinsic value to get to our acceptable buy price, given our investor margin of safety. And don't forget, we'll look at what Wall Street are forecasting over the next 12 months. Now, in today's episode, we'll do something a little bit different. We'll have 3 different targets. We'll have our low growth rate forward looking, our medium, and our high. So it's better that you understand how we are getting to our price targets. And if you don't agree, we do have more conservative and more optimistic approaches. So let's jump straight into that historical piece. Now, we can see they have performed very poorly yesterday as well as over the last few months. Over the last year, however, they are down 7%. Over the last 10 years, nonetheless, they are up an incredible 1,122%, with their all-time highs at $407 at the back end of 2021. And we can see towards their 52-week low with a forward PE of 57, which has come down significantly, and a market cap of $575 billion. Now, on the top line, for steady, moderate companies, we want to see 3 to 7%. For tech companies and fast-growing companies like Tesla, we would expect a lot more. 24.6 billion reported on their top line in 2019, 97 billion in 2023, so some very strong growth over the last 5 years. On top of that, we're seeing some nice granular level growth year on year, very positive to see. So this is still a fast-growing company on the top line. What about the bottom line? What can we analyze from that? Well, net income, or we should say in 2019, based on the brackets, this is a net loss of 862 million. From that point to 2023, they have turned a 15 billion net profit in that latest annual report. And on top of that, we do note those granular increases year on year. So not only have they managed to go from a relatively lower revenue figure 5 years ago to a very relatively high this year, but they have also been increasing their bottom line at a very strong rate as well. So that's a fairly positive sign on the income statement. Quick look at the health check of the company, total cash versus total debt. 2019, 6.3 billion reported in cash and short-term investments. Latest quarterly report, which was effectively their annual report, 29 billion. So they are now not just sitting on a larger amount of cash than they did 5 years ago, but a very healthy amount at 29 billion. Now, when we do compare that to their total debt numerically and directionally, we see that incredibly, not only was it fairly low for this company in 2019 at 14.6 billion, but it did also decrease to 9.6 billion over the last 5 years. So they've increased their cash short-term investments very rapidly whilst they're bringing down that total debt level over the same period. So very positive, should look favorably when we do look at some of the debt metrics to the EBITDA. In terms of their performance, now we're using the Mag 7 to compare Tesla. We can see over the last year, they have been the worst performing, down 7%. And as we can see, literally the only company with a negative return over the last 12 months. Now, when we do change that to the last 5 years, we actually see it as the second best performing, 880%, just second to Nvidia, up 2,112. So, as we always say on this channel, zoom out. Don't always look at that short-term performance, especially if you are bullish on a stock and you have your own investment thesis. Then stick to it if you generally believe that, because while in the short term with Tesla, you can see it is down, over the longer term, it has been one of the best performances. But a caveat to that, always remember that past performance is never an indicator of future performance. Institutional ownership, so that is 42% currently. $38 billion worth of sales by the institutions over the last 12 months. Surprisingly, maybe $34 billion worth of buys. So over the last year, institutions have been buying less than they have been selling. The notable thing here to note, though, is Q4 of 2023, institutions were buying a lot more shares. In fact, the largest sell that we see is in Q2. Since then, in Q3, we see relatively flat buys and sells. Q4, a lot more buying. So in conclusion, institutions over the 12 months sold more than they bought. However, in the more recent quarter, Q4, they have been buying more. And remember, always do your own due diligence. Never copy the institution. Buy, sells, minimum 100 shares over the last month to be a bit more relevant. With the insider selling, we do note it was the director as well as the SVP. Now, in total, they have sold around 20 million worth of shares. Important to note, insider buying bullish because insiders, in our opinion, buy for one reason. They believe the share price will rise. Insider selling, not necessarily bearish. They do sell for different reasons, personal, financial. But interesting to note that since then, on both occasions, the share price is down. In fact, they sold around $900 or $195 and $204. But again, take that with a pinch of salt. Now, before we jump into the financial metrics, we can take a very quick look at why we have seen Tesla stock tumbling continually over the last few months. And as the headline suggests, there has been some shipment slump, some new price cuts, which seems like they are doing this every few months with their products and cars. So let's take a look. Now, we can see that their shares have dropped according to this article for the more recent drop, in fact, as there have been numerous due to the multi-week lows as slowing China shipments and new price cuts hint at troubles for the EV stalwart in the largest car market. So that is a little bit of a worry, and what is quite nice to see is this on an essential graph. So we can see over the last few years, whilst it was increasing in 2022 towards the back end, and it did have a dip, we do in fact see it come down quite significantly in that latest quarter. So something just to bear in mind there. But again, you do not want to see any of these issues, especially in a market such as the EV market, where the margins, as we are noting from Tesla products, are continuing to be slashed. Now, before we jump into the metrics, just to let you know, we have released our latest free weekly article. If you want to grab a copy of this or the other articles we have written completely free, click on that pinned comment below and you can gain access. So let's look at the free cash flow per share. It is one I do prefer. Earnings is susceptible to manipulation by management through accounting. So looking at the free cash flow metrics, what we can see here is, whilst the first few years of the data shows negative free cash flow, since then it did turn positive in 2019. Very nice to note. Highs of 241 in 2022. And whilst it did drop in 23, we are expecting an increase into 2024. And do bear this in mind, as we will touch on this when we do look at that free cash flow or DCF model for the future growth. Now, sales growth, nice to note. In fact, every single year, double-digit growth to their top line. Very inconsistent. I wouldn't necessarily say it's decreasing. We have some years very, very nice growth, 2021, 2018, and 2016 notably. But then even in their more latest year, 2023, 19% is still very strong. And what we have seen, when the numbers do start to drop down significantly from the previous year, they do tend to rebound quite nicely. So it will be nice to see what management are guiding for 2024 and 2025. In terms of total sales, $3.2 billion in 2014, $97 billion in 2023. It has increased at a very rapid rate, and let's find out later on whether or not this is something we can expect to continue. Shares outstanding, well, they would have diluted your position over the longer term, going from 1.87 billion to 3.49. But if you had bought shares in 2014 and still kept onto them, you wouldn't really have cared, given how much that share price has increased. ROIC, now it is what I do prefer. I want to see 10% or more. Now this gives me faith that management are able to effectively allocate their capital. We can see 2020 at 5%. Nice to note it has gone from a negative and continued to stay positive from 2020 onwards. Even in 2023, where it did drop from that highs of 26%, personally this is still looking like a strong number. As long as it doesn't dip below that, then we should be okay for this company. Operating margin, again, we are looking overall in terms of the margins and the numbers. It has performed very well from the last few years of the 10-year period, where it was negative both on the operating side and the free cash flow margin side. Nice to note on the free cash flow, a little bit of consistency from 2019. We want to see at least 5%, so nice to note we saw that in 2023. And on the operating margin side, ideally around 12%, but do note, given the fact they continue to cut those prices on those cars, that we may be expecting this margin to drop slightly into 2024 and beyond. Net debt to EBITDA then, this is essentially the earnings before interest, tax, depreciation, amortization. Remember, correlates to that balance sheet strength. Essentially what this shows here is that over the last few years and into 2024, it won't even take Tesla one day to pay off all of their debt net of cash on hand. So very positive, very strong balance sheet, no worries there. So let's jump into the valuation of Tesla and get to the intrinsic value. Now, what would necessarily make up the intrinsic value would be these three models that we would use here: Graham's valuation, the multiples, and the DCF model. For today's episode and for Tesla, we just believe that the DCF model is the most appropriate. So we have their free cash flows year on year. Now we can see the average growth rate fairly skewed given the fact it was negative for quite some time. And we do note it did drop from 2022 to 2023 by 49%. Now we have three different growth rates. We have a low, a medium, and a high. Now for today's episode, we're going to assume the low of 30%. Now with that discount rate, we get the present value of future free cash flows and terminal value. When we add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, we get to an intrinsic value of $180. So what we're signifying here is that if you believe that their top line or their free cash flow, in fact, will be increasing by 30% over the longer term and over a long period, then the intrinsic value is pretty much at that market price. So right now on the current value, we see it as trading at its fair value. Now there may be some people who believe that is way too high, so we do have a low rate of 25%. So if we were to use 25%, again, this shows that the intrinsic value would be more around that $131, showing a large sign still of overvaluation of Tesla stock. Now, for those who actually believe it should be much higher than 25% at 35%, we can see that that would take the current trading price to around $245. Now, again, it does depend on whether you believe that these are low, medium, high are sufficient. If not, and you believe there should be different numbers here, you can always grab a copy of this model in the comments below. Grab one or use it for your own numbers, whether it's for this company, for Tesla, for others in your watch list, or even those on your portfolio. So we're going to move forward with the essential medium target of 30%. And what we're essentially saying here then is that Tesla is trading at its intrinsic value now. If you are looking for an acceptable buy price, we would then use a margin of safety. We'd start off with 10% if we believed it met three criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that, then a buy would be around $162, at 15% around $153, and those at 20% around $144. Again, right now it is currently trading around its intrinsic value. In terms of Wall Street and their forecast over the next 12 months, well, they have a price target of $212. They see upside of 17%, so they do believe this is a fairly strong buy now. But as always, I'm interested to hear your thoughts and comments. Is this one that you believe is currently trading at intrinsic value? Are you buying at these prices? Or even if you have any questions about the medium, low, or high growth rates, whether you believe they should be much higher or in fact a lot lower. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And as always, we'll see you on the next one.